Today's workshop, which is being presented by Community Engagement Committee of the Boston Estate Planning Council. A big thank you to their team for sharing their time and expertise with us. This session today will cover some key personal financial topics, like how to track your money, take a snapshot of your finances, and make a plan to reduce debt. At the end, we'll open it up for questions, so feel free to join. Feel free to jot down anything you'd like to ask during the presentation. A quick heads up to everybody is that today's workshop will be recorded, so if you'd rather not be seen, you're welcome to keep your camera off. After the session, we'll also be sending out some helpful handouts. We'll be sending out a cash flow worksheet, a personal balance sheet, and a debt reduction worksheet. We hope these tools give you a great starting point for taking control of your finances. And we are also going to wait. We're also going to have everybody wait to ask questions until afterwards. And at the point of question and answer time, we will then stop the recording, so nobody will be recorded during their question and answer period. So now I'm happy to introduce Jennifer Hall, and she will, from Boston Estate Planning Council, and she will introduce her team. Thank you, Jennifer.
Thank you, David. Hi, everybody. And my colleague is joining me, Caroline McKay. We are the co-chairs of the Community Engagement Committee for the Boston Estate Planning Council. We're happy to be here today. And we're going to be talking to you about building your financial foundation, a guide to smart money management. And we'll tell you. Oh, go ahead, Caroline.
All right, well, hi, everybody. Very nice to meet you. As Jennifer mentioned, we're members of the Boston Estate Planning Council, which is a council of almost 700 members that represents, attorneys, accountants, bank and trust officers, and wealth management advisors in the Boston community. And as part of our council, we have designed a community engagement committee that is focused on creating financial literacy programs for the community. And we're really happy today to have our first collaboration with Tailored for Success. So Jennifer and I are going to split up the content a bit today. I'm going to cover income and tax withholding information, and then budgeting and expense planning. And then I will turn it over to Jennifer to do the building credit and debt management part of our discussion. As David mentioned at the beginning, if you have any questions, please jot them down. We will take time at the end for you to ask those questions. Just to give you a heads up, we are going to cover what we find to be, financial foundational information. Some of it may be, more basic. Some of it may be advanced for you. But again, we're here and we're a resource to you. So write down those questions. So the first topic is income and tax withholdings. And I think this is a really important base to a conversation that we're going to move into, which is on budgeting and expense management. But in order to even set a budget or to really think about how do you put yourself in a great financial position and start working towards financial goals, you need to know what income sources you have, where it's coming from, and understand the difference between your gross income and your net income. So the types of earned income that all of us tend to receive, depending on what we do, is very basic is earned income. That is income earned by working in a job. So if you receive a paycheck, you are receiving earned income. There are other types of income that one can generate, like income from assets or investments. So if I'm invested in the stock market and I'm receiving dividend income or interest income, that is income that I will pay taxes on. If I have more passive income, like I have a property that I rent to somebody, again, that's income. Not only is it important to know sort of the differences between earned income and other types of income, but we also know that people receive other types of income, potentially from public benefits or entitlements, from Social Security, through disability income, through grants. And when we look at all those different types of income, one of the big reasons we distinguish between them is because depending on the type of income you receive, it may affect your tax rate. So generally earned income from, an employer, that's going to be subject to what we call ordinary income tax. And there are various income tax brackets associated with your earned income. So the more you make, the higher up in taxes you'll pay. Versus if you have investment income, that typically, depending on the type of income, may be subject to either ordinary income tax or can be subject to capital gains taxes, which capital gains taxes tend to be lower. Also, if you're receiving Social Security income or disability income, not all of that income may be subject to tax. And so that's why it's really important to sort of have a baseline understanding of where your income is coming from and how it might be exposed to taxes. So when we talk about this idea of gross versus net income, you can see right on the bottom here, gross income minus deductions that are taken from that income typically equals net income. So think about this in the framework of a salary or your paycheck, right? Let's say you're making $25 an hour and you work 40 hours a week. If we multiply 25 by 40, that would provide effectively our gross income amount. But as all of us who've ever received a paycheck know, we never get our gross amount in our wallet at the end of the day. And why is that? That's because deductions are taken. Some of those are mandatory deductions, and that's typically taxes. So income taxes are withheld, income or taxes for Social Security and Medicare are typically taken out. So those are examples of mandatory deductions. And then optional deductions would be those deductions if you have, let's say, health insurance offered by your employer, or you have the ability to contribute to a retirement plan, and you've elected to participate in those programs, then those deductions, your contributions towards those programs or benefits, those are what we would call optional deductions. So we have our gross amount, we take out the required withholdings, which are typically taxes, we take out our optional withholdings, and that provides us our net income take-home pay. And again, if you are in a journey where you're looking to create a better foundation for your financial future or looking to incorporate strategies like budgeting, this is critical information for you in order to be able to appropriately manage those types of exercises. So I think it's always helpful to take a quick look at, a typical paycheck and all the information we need in terms of what we were just talking about. What is our gross income? What is our net income? What are the mandatory and optional deductions? Typically is going to show up on your paycheck. So I'm just going to give everybody just like 10 seconds to take a look at the visual on this screen, and hopefully it's not too small. And just take a look to see if you can identify where it talks about gross pay versus net pay. And do you have a good understanding of the differences from the deductions listed on the screen as to what are mandatory deductions versus optional deductions? So I'm just going to take a 10-second pause. All right. So I know it wasn't a long time, but hopefully you've seen on this pay stub a little bit of the information we've been talking about. So we have John Smith here, and if we see what his take-home pay was for this week, it was $959.79. This is what we would call his net pay. That's what he's actually putting in his pocket that he has to spend for needs and wants and hopefully savings. But that's the take-home pay at, let's say, the end of this week. If you look down here, and I'll actually highlight some of these things, we see net pay there, the gross pay, which is, again, whatever our salaried, however many hours we worked, multiplied by what we were paid on an hourly basis. That should all be laid out typically on your paycheck, right, somewhere looking down here where I'm highlighting right now. You'll see your pay period, so we'll understand, are we being paid weekly? Are we being paid bi-weekly? Are we being paid monthly? And then over here, you see where we see federal income taxes, Social Security taxes, Medicare taxes, state and local taxes. If you happen to live in a jurisdiction that implies a local tax, you'll see that. But those all qualify as what we call those mandatory deductions. And then if we're contributing towards health insurance or a 401k or other type of employer provided retirement plan, that's where the optional deductions come in. And when we reduce the gross pay by all of these taxes and optional deductions, that's again where it equals net pay. I find more and more, I mean, we live in such a digital world now that a lot of us may do what's something called direct deposit, where our paycheck is going right into our bank account. Uh, and you might not always be looking at your pay stubs, but it is a good practice to always go back and review your pay stub and make sure, especially if you're an hourly worker, that you are being paid for the hours that you have indicated that you worked. Or if you do work overtime or you are supposed to receive commissions, tips, it's just really good practice to go back and be checking your pay stub, even if the money is automatically being deposited.
And that pay stub may be on a, an electronic, site that you need to log into, but you're entitled to that information. So Caroline's point is just, take a moment to review that information.
Absolutely. Thank you, Jen.
Mhm.
And well, I'll go back one slide. So here again, we are looking at the federal income tax amount, which here it was 104.23 for this pay period. A lot of people will ask, well, how do we determine how much federal tax is taken out of your paycheck? Because you can have the exact same pay as a coworker, and if you compared your pay stub, you might have different amounts of federal income tax being taken out. And a lot of that has to do with your withholdings. So again, many of you will recognize that when you get a new job, or your employer might ask you year to year if you want to update your withholdings. That's all done through the IRS form W-4. And then again, in a state like Massachusetts, where we also have an income tax, there's a comparable Massachusetts form that also allows you to put in what we call your allowances or your withholdings. And the number you put on that form, and that form is now, I think, primarily done digitally, but there may be instances where you still fill it out by hand. What you put on that form is going to determine how much the federal government and the state government is going to withhold from your paycheck. So if you put fewer what we call allowances on that W-4, you are going to have a higher withholding amount. If you put if you put more allowances on your W-4, you're going to have a lower withholding, which means a lower tax. And what are these allowances? They're typically sort of different buckets where they say that you can sort of reduce how much income tax is being withheld from your paycheck. So for example, if you are married, so you get an allowance just for yourself. If you're married, you get an allowance for that person. If you have children, you can take allowances for children. There's a bunch of different reasons why you can take more and more allowances and try to reduce the amount of money that's being withheld from your paycheck. And the reason the IRS does this is they think, well, at the end of the year, in April, when your tax return is due, you typically, if you are, let's say, married and have children, can often take deductions against your income because of the standard deduction, because you have the child tax credit, because you're married. So what their IRS is trying to allow you to do is factor in those deductions that typically come up on your tax return and allow you to keep more in your pocket week to week, month to month. What's really important, we're going to talk about this on the next slide, is you really want to be careful about how you think about your deductions, because if you, let's say, put too many allowances on your W-4, and you don't have comparable deductions in April that match those allowances, then you're going to owe tax, right? And if you do your no allowances, you may get a refund. So that's how the whole system of refunds versus owing taxes associated with earned income typically comes up. So before I go to the next slide, I do also just want to point out that this IRS tax withholding calculator, if you've never done this, and you'll have this after our session today, or you can copy it down. This is a great tool on the IRS website that allows you to put in what you're making, what your spouse, if you have a spouse, is making, allows you to put in whether you have children or not, and it can help calculate what your withholding should be so that either you end up neutral come April, so you don't owe any taxes, or if you do want a refund because that's a way you like to do some planning or savings, it can help you do that. So that's a really tremendous calculator that I recommend everybody check out. So let's talk about a tale of two tax withholdings. I remember I said you and your coworker could be making the same amount of money, but you may have different net take-home pays, partially due to, maybe some of the benefits you're participating in, and also your tax withholdings. So we have Alice and Bob here who both make $50,000 a year. Alice has chosen only taking one allowance. So again, maybe she's single with no children, or there's other reasons why she's choosing to have very few withholdings on her W-4, whereas Bob is taking 4 allowances. So that number on his W-4 is a 4. They both receive the same gross paycheck. So again, at a gross level, we're at 4,166. But then because of their tax withholdings elections, the allowance 1 versus the allowance 4, we see that Alice is having $600 a month taken from her paycheck for tax purposes. So that's $7,200 a year. Whereas Bob is only having $300 a month taken because of his 4 allowances. So you can see there's a pretty big discrepancy with the amount of tax withholdings they're doing. So Bob is going to have higher net pay, month to month, week to week throughout the year than Alice will have. At the end of the year, though, let's say again, in most cases, their deductions are somewhat comparable. They're both going to owe $5,000 at the end of the year. So what does that mean? That Alice has withheld more money throughout the year and Bob has withheld less. Well, Alice is going to receive a $2,200 refund because she effectively has overpaid her taxes for the year. Whereas Bob is going to have to come out of pocket $1,400 because he had more allowances and thus did not pay enough of tax during the year. So again, this W-4 and what you put on that form is a critical piece to sort of managing your monthly net or weekly pay, and then also sort of truing everything up at the end of the tax year, come April, in terms of whether you're going to receive a refund or whether you're going to owe money. So another option or another area we should mention is that, we've been focusing really on, in these previous slides, what we would call sort of a salaried or an employee person, so somebody who receives their pay from an employer. But we know, and Jen and I both work with clients who are either self-employed or they're independent contractors. So, they're being paid by somebody, but they're not considered employees. So in that case, your tax withholdings are going to be different because you may not have an employer giving you a paycheck that's taking the money out for you and paying the employer side of taxes. So if you're self-employed or an independent contractor, it's really important that you understand what your tax liabilities are, because you actually are going to have to set money aside to pay those taxes. It's typically paid quarterly, known as estimated taxes. But it's really on you to be able to put the money aside and pay that. So that's an extra level of sort of financial management that you'll have to consider to make sure that you don't find yourself woefully having underpaid taxes and owing a huge tax liability come April. Okay, so now we know where our income is coming from, and we know the difference between our gross income, our net income, and where some of our money is going with respect to taxes and optional benefits. The next piece that we'd like to talk about is budgeting and expense planning. And this really is one of the most, important foundational financial planning tools in terms of really, again, getting yourself either into a place where you're saving money or you're paying off debt or whatever your financial goals are, knowing where the money is coming in and how it's going out, and taking a critical review of what changes or tweaks can be made to meet goals is a really powerful exercise. So let's quickly talk about what a budget is. And a budget is really just a financial plan that outlines the expected income that you have and the expenses going out. And the goal is to help manage your finances effectively. So it can help you control your spending. So if you know that you only have a certain amount coming in, and you know what some of your critical expenses are, we typically call them your need expenses. So that would be your rent, your insurance payment, your car payment. I mean, your utilities. You need to have electricity and internet and a phone. So those are your critical needs. And then there are the things that are your wants, which might be going out to dinner, going to the movies, going on vacation. All of those are things that improve our lives and we all want to do, but they aren't absolute must-haves. And the whole goal of being able to track your budget or to track your expenses in relationship to your income is so that you can try to, again, put money financially aside towards your savings goals, which might be, I need to retire one day, or which is a sort of long-term goal, or I need to build an emergency expense fund, which typically is a fund that covers 3 to 6 months of expenses. So if you had a medical issue or you were unemployed for a bit of time, you have money to turn to help cover those critical expenses that you have to pay month to month. So the typical budgeting methodology that a lot of us are using these days is called the 50-30-20 budgeting rule. And the idea there is that 50% of your net take home, pay is going to go towards those critical needs, right? The things that are non-negotiable, you need them day to day to live. You have to have a roof over your head, you have to have your utilities, things like that. 30% is going to go towards those more discretionary, fun things to do. So I like to go to the gym. I want to go, on vacation, all the movies, eating out, whatever it is for you. And then 20% is going to go towards savings or debt repayment. Okay. So we have in planning our budget, the real goal is I want to take my income. I want to set aside the money, that 20% if I can, for savings. And then what's left over is the money I have for expenses. And hopefully I can fit them into that 50-30 sort of measure. In reality, and we'll talk about how you go about budgeting, you may find that your needs are more like 75%. And so that's okay, but then you really only have 10% to spend for the wants if you're trying to stick within this methodology, right? Or you may find that you actually live very frugally and you are, you don't have a mortgage or you have rent control, whatever it is. Maybe you find you can fit all your needs and wants into 50% and maybe you can do a ton of savings. So the goal is to kind of fit in this model as best as you can, but keep this in mind in terms of most of us end up finding that we need to trim back expenses in order to meet this model. So one of the ways that we need to go about and how we start a budget is really thinking about tracking our expenses. So one idea is, and you're going to get some handouts following our session today. You want to have a balance sheet of all the assets you have and all the sources of income you have. And then you need to create sort of a cash flow spreadsheet or model that shows where is all your money going in terms of expenses today. So in order to create the budget, we first need to know how are we spending our money. So what's coming in, what's going out. And we typically categorize this, again, you can see on your screen, we have income in one section, we have our expenses. Everybody does the expenses a little bit differently, but there's some things called variable costs, which are things that change all the time. So think about your grocery bill. You don't spend exactly $200 a month on groceries. One week it may be smaller, one week it may be more. So that's a critical need, but something that goes up and down. And then there's something called fixed expenses, which is typically like a mortgage payment or your homeowner's insurance or renter's insurance. Um, like your phone bill typically tends to be pretty standard month to month. So we start collecting all of our expenses and we figure out, and a lot of people, what they'll do is maybe list their fixed expenses at top and then their more variable expenses at the bottom. And then we'll go through those and also categorize those as which ones are my absolutely need to have expenses and which ones are more discretionary. And the discretionary ones are the ones that we typically are going to go to first when we need to do this budget model and we're looking to try to pare back some expenses to meet our savings goals. We typically are going to start with those discretionary expenses because that's the ones that fully in your control that you don't have to have. And then we start looking at sort of the more critical needs. And are there any ways to reduce spending? Can I, let's say, renegotiate or change my phone carrier to save money, right? That would be an example of being able to change the cost of a need to have expense. And then in that same sort of budgeting model, we're going to be listing our savings, and any sort of debt management, like what are our credit card bills that we need to pay off. So we'll give you a sheet on that, but tracking your expenses, as it says, helps you understand, how you're using your money and is it in line with the goals that you're trying to set. So once you have a month or two of an understanding of how you're spending your money, then you can look and start mapping out what changes you're going to make in order to try to fit into maybe that 50-30-20 model that we were talking about.
Also important, as you go through the budgeting exercise, a lot of folks maybe pull out a sheet like this, or maybe you'll use the handout that we provided, but it's important to compare what you've completed in these categories to the actual, what's actually being spent. So there's, you have the ability, whether it's credit card, debit card, checking account, to pull or review those transactions and make sure what you believe to be is the allocated expense matches what's actually going out, and just making sure that that budget is accurate. It's a fluid process. It takes a little bit to get it, as accurate as it could be, for sure.
Yeah, and thank you, Jen. That's a really good point. Like, so once you create the budget, you actually have to see if you're staying in line with the budget you created. I will also mention everybody's different. We're going to be giving you a paper handout that you can use to start working on this. But we also know we live in a very digital age. A lot of people will prefer to use budgeting apps like Rocket Money or You Need a Budget app, which some of those are start off free. And maybe if you want a lot of bells and whistles, you can upgrade in those apps. But that's a great place. And those can link to your bank accounts and credit cards to help you track all of this. So if you find yourself more digitally inclined, you don't have to do everything on paper. But I'm sort of old school and I kind of like laying it all out on a spreadsheet in front of myself. So if you happen to be receiving any sort of public benefits where the resources that you're receiving are tied to asset limits, having a budget is also particularly important to think about how you're spending and how your savings and how that could affect your eligibility going forward for some of these public benefits. And there might be opportunities where you can save money in different ways or use your income in ways that will avoid exceeding asset limits. So as an example, like there may be ways that you can put money aside if you have like a disabled child, and there are certain accounts you can put savings into to help protect that. So we won't go through all that today, but we did want to point out that you do, if again, if you are receiving income that is based on eligibility and income limits and savings, then you're going to want to make sure you understand those rules, and hopefully seek some guidance on how you can preserve those benefits. Finally, in terms of managing expenses, another reason we find that a budget is so helpful is, again, a lot of us, unless you're paying cash and keeping sort of a log on how you're spending your money day to day, a lot of us are using debit cards or credit cards. And you don't always stop and think about every purchase and how that fits into your budget, or you're maybe not paying as much attention because, again, you'd have to review your credit card bill or go through your bank account and look at every line item. So part of the deal of budgeting is it does require you to sort of go back and look at things regularly to see if you're on budget. And by doing that, oftentimes you're going to find that you're better at actually managing your expenses. So avoiding late fees, and not being hit with interest on unpaid balances, not getting hits to your credit report. And that's all stuff Jennifer is going to mention in our next session, or any other additional charges. So there are many benefits for spending some time and going through creating a budget and going through sort of this expense analysis. Is it's also going to help you potentially get rid of duplicative expenses that you might have, opportunities to reduce expenses that maybe you just hadn't realized had kept going up and up and up, and you have some ability to reduce that. And also, again, avoiding late payments or unnecessary interest. So with that, I am going to turn it over. Oh, wait, I'm sorry. I had one more slide on keys to savings. So in that 50, 30, 20 model, you know, the point of doing all this budgeting oftentimes is because we want to get to a position where we're actually saving more money. And again, that may be to create an emergency expense fund, to go on a vacation, or to buy a house, or very long term to have money aside for retirement. So a great exercise in doing this whole budget sort of approach is sit down and write out your savings goals and identify your short term, which might be, again, saving for an emergency expense, or I want to go on vacation next year, so I have a 12-month window. So that's a short term savings goal versus a long term goal like saving for retirement. And as part of that savings exercise, the goal will be hopefully in articulating what those goals are and seeing sort of the time frame that you're giving yourself. You will be motivated to reduce expenses wherever you can, and you will be motivated to pay yourself first rather than paying more expenses. You want to invest in yourself and your savings. We always need to determine, once we're on a saving path, where are we going to put that money? So if we're retirement planning, that may be in an IRA or a 401k or a SEP IRA. There's lots of different retirement vehicles. But if it's just a traditional, like I'm saving for that vacation, maybe because I'm giving myself 12 months, I want to hold that not just in a basic savings account, but maybe in a money market savings account where I could earn potentially 3 or 4% interest on that money. So it can only help me in that savings goals. I also will tell a lot of people, if you can, obviously we talked about those optional deductions associated with your take home pay or your salary. If I have a 401k that I want to invest in, that will go right from my employer to my 401k if I elect that. But if, let's say, I'm just saving money I'm going to save it in my savings account, right? Sometimes rather than receiving the whole paycheck into one account and potentially being tempted to spend that, a lot of times we'll say, take that 20% number or whatever the number is for you, and can you ask your direct deposit to go right into a savings account? So oftentimes with your paycheck, if you have direct deposit, you can put some into your, let's say, your checking account or your debit account, and you could put some aside into a savings account. And that, if it's not in your regular spending account, you may be better about not touching it to meet those savings goals. And then obviously, long-term saving for retirement is very critical. And, hopefully you can learn more about the different vehicles associated with that to make sure you're sort of maximizing your contributions and potentially any matches from employers. Okay, now with that, I'm going to turn it over to Jen.
Thank you, Caroline. So now we're going to move on to using and building credit. So we've discussed income, we've discussed budgeting, and what if there are some items or things like a home or a car or things that we can't, pull out of our savings account to pay for? How do we go about that? And providing ourselves with financial flexibility. So people utilize credit and debt for many reasons. The key here is utilize. Debt isn't always has a bad connotation, but it can be a really great tool if used carefully. Credit and debt is used to purchase assets, pay bills, cover unexpected expenses or emergencies, or buy something that we want or need. The key, though, is there are things that are considered to be good debt or bad debt. Good debt is something that will appreciate over time, like a home or maybe a student loan where we're improving ourselves. Or there's also bad debt, which is something that will depreciate over time. So something like a car, we've all heard, as soon as you drive the car off the lot, it's worth less than what you paid for it, which is a depressing thought, but it is the truth. Or something like credit card debt, which is, can be overwhelming at times. The cost of borrowing. When borrowing, it's important to remember that you're ultimately going to pay more than the initial amount that you borrowed. And this is because you're paying for the convenience of having access to those funds immediately. There are three main components of a loan. That is, of course, first the principal, which is the money that you borrowed. Next is the interest, which is the amount that the financial institution will charge you for allowing you to use its money. And that can come in two different types. The first is a fixed interest rate, which means it stays the same, which means your payments stay the same. Then there's also a variable rate, which adjusts to market rates and can go up and down. And this kind of goes back to your budget. Variable rates, that is a little bit more difficult to budget. So it's important to understand the difference between the two. And then lastly, there are fees, which could be an initial application fee or an annual credit card fee. I think the one other point that isn't included on the slide is also the term of the loan. Not so much, on a credit card, but something like a car or a mortgage. It's important to understand what the term of the loan is. So, kind of building off of the interest rate, how is that determined? This is most likely tied to your credit score. So a credit score is a measure of financial trust, your credit worthiness, so to speak. And lenders look at this score to determine whether you qualify for a loan to begin with, and if you do, what is the rate that they will charge you. The better the score that you have, the better the rate that you'll get. And there are three credit reporting bureaus that compile data. They all have a different way of compiling that data. So your credit score may vary between these three institutions, and that is Equifax, Experian, and TransUnion. So it's important to understand it may be slightly different across three, but either way will give you a good idea of where you stand.
And you may be mentioning this next, Jennifer, so I don't want to get ahead of it, but all of these crediting reporting agencies do allow you to receive a free credit, your credit history and your credit report at least once a year. So again, it can be good practice on a Saturday someday, once a year, go in and look up your credit history through these three agencies and make sure that your credit report is in line with how you believe it should be. But I know Jen will talk more about credit scores.
Definitely. Good segue. So, what is this mysterious credit score? A lot of people don't really know what goes into compiling that score, and we have it laid out here for you to understand. So there are 5 different components. So the first and most important you'll see in the dark blue is at 35% of the score takes into account your payment history. So do you make payments on time and as agreed? And that's, at least the minimum payment. And this shows lenders that you are dependable. So that is why it's, the biggest part of the score. Next is amounts owed. So how much of your available credit have you used? So a great example of this, let's say you have 2 credit cards, each have a limit of $2,500. So that means your available credit is $5,000. If you are running up that card up to $4,999, that shows that your credit utilization rate, as we call it, is 99%. The typical rule of thumb is to keep that revolving utilization at 30%. So that would mean if I have those 2 credit cards, again, each at $2,500 limits, I would want to keep my combined balance at $1,500 or less. And that just shows, you're not, really relying upon that available credit. And I guess one important thing to note there is that revolving utilization rate is calculated based on what's shown on your statement every month. So if you make a payment prior to that statement coming out, you can kind of play around with how that revolving utilization rate is calculated. So, if you find that, your balance is maybe that $4,999 that we talked about, paying that off a few days prior to maybe reduce that amount, you're able to manipulate what that rate is. So just remember that you don't have to wait for the statement to come to pay the credit card. Next, at 15% is lines of credit history. So that's the average length of the credit card or the loan that you have outstanding. Again, this is all showing your credit worthiness. So if you have, if you just started out and you have maybe 2 credit cards and they're less than a year old, that may not be working for you as you may think. So the older those credit cards get, the better. And that's, a point that we'll talk about later is if you can avoid closing a credit card, officially closing it, we'd advise that because it keeps that credit history on your credit report. So whether you need to cut up the card or hide it somewhere that you don't use it, just to maintain that credit history. So be it, of course, don't be afraid to close it if you have to, but just understanding how it's, going into your overall credit score is important. Next up is types of credit. So what types of loans that you have, whether it's credit card, mortgage, car loan, student loan. That doesn't mean you have to go out and get one of each, but just know that that comes into play. Maybe if you only have a credit card, you may be wondering, why is my credit score not going up higher and higher and higher? That may be at play, and just to keep in mind. And lastly, new credit. So how much of your available credit is new? Our colleague Russell likes to say this quote, and so I won't pretend that it's mine. So don't allow someone else to know more about your financial situation than you do. So great example here is, let's say you're car shopping and you want to go to multiple dealerships. You want to know what rate they're going to provide to you. Each one of those dealerships is going to pull a hard credit report on you, and that's going to show up under this kind of new credit umbrella, as if you're going to go forward and engage with that specific dealership. So if you already have an idea of what your credit score is, then you can go and ask, what is the range? They may not give you the exact rate, but what is a rate that I would expect based on my credit score of X? And knowing that that will impact your credit score, the more inquiries there are, or new credit cards there are. So what is a good score? So we have this, mapped out here for you. This is, again, going back to the FICO score, which does compile the information from those 3 credit reporting agencies that we mentioned earlier. Above 740 is considered excellent. Above 670 is very good. Most credit cards will post this FICO score on your statement. So again, Caroline mentioned pulling the your one free credit report that you get each year, which is a lot more detailed, but you're able to at least see what your score is. Most likely, I think a lot of places are starting to do it now, even banks maybe on your statement. You're able to just take a peek and monitor that at a high level. So let's say, you've reviewed your credit score, maybe you've done a deep dive on your credit report, you like what you see, how do you maintain it? And that is, paying all your bills on time. This is going back to budgeting. Maybe you set up auto pay, you make a schedule, you make sure that, of course, that there's enough funds in your checking and savings account to avoid overdraft fees when you do this, but coming up with a plan, maybe setting yourself up for success by establishing that auto pay, making it easy for you. Again, keeping your credit utilization low. We talked about that, maybe paying off that credit card prior to the statement comes out. And then also, again, as mentioned, keeping older accounts open to maintain that good credit history is also something to consider. If you reviewed your score and you feel that it needs improvement, ways that you can do that first is really taking a deep dive on that credit report, making sure that everything on there is accurate. We have heard many instances where there are things that are not accurate, have nothing to do with you, maybe was a mistake, and maybe hurting your credit. So making sure that everything on there is appropriate. If you do see, something on there that is accurate, but maybe, hurting the credit score, there's a good action to take is something called a goodwill deletion. So that is asking a creditor or collection agency to remove a negative mark on your credit report, which some negative marks can stay on for 7 years. So it's a considerable amount of time. This makes sense if you missed a payment due to financial hardship or a medical issue, or even something as simple as you moved and you never received a bill, so you didn't pay it. It never hurts to ask. It's free to ask. Go ahead and do it. And there may be also a way to negotiate different terms on that loan to be able to repay it. Another thing to mention, as far as repairing or building a credit history, there are ways that you can document the other payments that you may make that aren't necessarily captured through these, credit agencies as in a more traditional way. Something called Experian Boost is available to you. I'm unaware if the other credit bureaus do it. I'm sure that they do. I just know of Experian. And this is, you log on to Experian, it walks you through how to post your bills and then provide proof that you've paid them. By doing that, you're able to capture, things like rent, cell phone bill. We've listed other examples on the slide here to give you credit for paying those properly. So next up, we're going to talk about how to manage this debt and a couple strategies when going about that, which we've also included a handout to do so as well.
Oops, sorry.
No, it's all right. Oh, thank you. So I guess the main takeaway before we go through those two methods in paying down debt is just what are the overall takeaways here? And that is going back to, what Caroline talked about is having an understanding of the loans that you have outstanding. So who you owe, how much do you owe to them? What are the payments? When are they due? And going back to the interest rate, the type of interest rate there, and creating a schedule, again, if that's electronically, if that's on paper, whatever works for you, but just kind of laying it all out on the table and being able to create or think of a way that you want to tackle tackle this debt. And two ways that we're going to talk about of doing that. First is something called, or I guess before I go through the details, it's important to note there is no right or wrong. You get to choose which one you like the best. The whole point is that you've come up with a plan and that you want to tackle it and get started. And these are just some ideas. So the first is the avalanche method. So that is paying down the highest interest rate first. So of course you make minimum payments on all the debts that you have, but you then focus on paying down the debt that has the highest interest rate, which is the debt that is growing the fastest. This eliminates debt much faster, and in effect, you'll be paying less interest overall. Another method is the snowball method, and that is by paying down the smallest balance first. So again, maintaining, those minimum payments, but you then focus on paying down the smallest, the card or the loan with the smallest balance. And this just helps to build your confidence. It feels good to kind of cross one off the list. That's why there's no right or wrong answer, whatever one makes you feel better. But by, completing one or paying off one full debt, it feels good. And then you would then move on to the card or loan with the second lowest balance. And we have an example just to illustrate this. So let's take a look at the table here. What do I have? I have credit card A, and the interest rate on that card is 26%, and the balance is $3,000. I have credit card B with an interest rate of 22% and a balance of $800. And then lastly, I have a personal loan at 15% with a balance of $1,800. The avalanche method is applied. I'll give you a second, maybe think about which debt I would look to pay off the first. And I guess interest of time, I just glanced at the clock, sorry. You would probably look to pay down credit card A. So that is the loan with the debt with the highest rate. Snowball method, taking a look at this example, you would look to pay off credit card B first and then move on to the personal loan. And that's because the credit card B has the smallest balance. Apologize there for going up. Go ahead, Caroline.
No, and I apologize. I took way too much time. But and what we find sometimes is that clients may switch. So again, if you, let's say, look at this balance sheet and say, you know what, I just want to get the $800 one out. I can pay that. Great. But then you may say, rather than staying with the snowball method, which is just paying off the lower balances first and going up, you may then switch after the $800 card B is paid off and say, now I really actually want to tackle the one with the highest interest rate as fast as I can. So you can combine, again, there's no right answer. Part of the goals is just whatever feels right and helps you start actually paying down the debt.
I'm going to stop the recording